Welcome to the deep dive. We're here to, cut through some of the noise in this constantly shifting global landscape and hopefully bring you a bit of clarity, some key insights. There's so much information out there, right? But really getting a handle on what's happening and even more importantly, why, well, sometimes that feels like hunting for that needle in a massive haystack. Today, we're taking a really important deep dive. We're digging into the World Investment Report 2025. It's pretty much the essential source if you want to grasp the complex world of international investment trends. And our mission for you listening is to pull out the really crucial nuggets from this report. We want to explore how the whole investment landscape is evolving, paying special attention to the digital economy and sustainable finance, and ultimately figure out what these big shifts mean for you and for the world. So let's just jump right in, because the headline number from this report, well, it's quite stark. Global foreign direct investment, FDI, actually saw an 11% fall in 2024. And that's after you take out those really volatile flows through what they call conduit economies.
The places use sort of like pass-throughs, often for tax reasons. They can really skew the picture of where money's actually landing.
Exactly. They cloud the real destination. And this drop marks the second year in a row of decline. What's more, the outlook for 2025 is, well, frankly, negative. Investor uncertainty is just really high right now.
So a gloomy global picture. But you mentioned it's not uniform. There are regional differences?
Oh, absolutely. Fascinating contrast. You see a really sharp fall in investment flowing into Europe, for example. But at the same time, investment is actually rising in North America.
Okay. And what about developing countries?
For developing countries overall, FDI flows were basically flat. But that hides a lot. There were sizable increases in Africa and Southeast Asia, which is encouraging. But flows actually fell in East Asia and South America. And crucially, FDI remains incredibly concentrated. Just 10 recipients, think China, Brazil, Mexico, Indonesia, India, among others, they account for 3/4 of all the FDI inflows going to developing countries.
3/4 to just 10 countries. Wow. So what's driving this overall downturn? You mentioned uncertainty.
Yeah, and if we connect this to the bigger picture, it's really interesting. The downturn was largely driven by financing constraints. Think about the constant uncertainty swirling around exchange rates and interest rate levels. Basically, the cost and predictability of doing business internationally.
Right, the money side of things.
Precisely. And this impact, it's been especially harsh on the least developed countries, the LDCs. For them, even small shifts in financing conditions can have really outsized negative effects.
So it's a financial squeeze hitting hardest at the most vulnerable. Is that the whole story, though? The report mentions policy, too.
No, definitely not the whole story.
Yeah.
The other major force that's fundamentally reshaping these global FDI patterns is trade and investment policy itself.
Yeah.
The current tariff escalation we hear about, it's not entirely new, but it's certainly an acceleration of trends that were already underway.
Acceleration.
Yeah. And perhaps even more impactful is how multinational companies, the MNEs, are reacting. They're not just tweaking things. They're actively restructuring their entire supply chains. Remember the pandemic disruptions, the shipping chaos, like that Suez Canal blockage? Now add this growing political pressure for more localized production, especially in sectors deemed strategic.
Right. Bringing production closer to home or at least to friendly places.
Exactly. It's not just about finding the absolute cheapest place to make something anymore. It's shifted. Now it's much more about securing your supply, diversifying away risk. Resilience is the key word.
So this restructuring is actually happening. We see it in the data.
Oh, clearly. Look at greenfield project announcements that's building new facilities from scratch. For manufacturing, these announcements jumped 22% in 2023, 22%.
Wow.
And then they increased another 5% in 2024. This is significant because it breaks a trend of over a decade of negative growth in manufacturing greenfield projects. It's a real signal. It points towards a much more urgent reconfiguration of production networks. The drivers are risk diversification, ensuring security of supply, and increasingly geopolitical alignment, especially in sectors really sensitive to trade policy changes or ones that rely heavily on that just-in-time logistics model. It's a fundamental rethink.
Okay, so let's dig a bit deeper into the types of investment projects that make up this picture. First, you have cross-border mergers and acquisitions, M&As. Buying existing companies. These directly impact those FDI flow numbers we talked about. And the news here isn't great either, is it? Deal activity really slowed down in the first quarter of 2025, like back to levels we haven't really seen since the global financial crisis. Paints a picture of cautious investors.
It does suggest caution, for sure. But interestingly, it's not a completely bleak picture across the board. While that corporate M&A slowed, private equity activity actually rebounded quite strongly in 2024. up by a third.
Really, where was that focused?
Heavily concentrated in the technology sector. Tech accounted for nearly one-third of the entire global buyout value. So while big companies might be hitting pause on some acquisitions, private equity firms are definitely still seeing opportunities, especially where there's innovation.
That's a key difference.
Oh.
Okay, then we have greenfields projects. You mentioned these building brand new facilities like factories or data centers, usually in industrial and service sectors. And these are arguably more impactful for development, right? Creating jobs, bringing in new tech.
Absolutely. They often have a more direct, tangible development impact. Now, in 2024, the number of greenfield projects in industrial sectors did increase slightly by 3%, but their total value fell by 5%.
So more projects, but smaller ones on average.
Kind of, but the overall aggregate value was still incredibly high, $1.3 trillion. And that high value was mainly propped up by a huge surge in the information and communication technology sector, ICT.
The digital economy again.
Exactly. We're talking massive investments in data centers, data processing facilities, basically the plumbing of the digital world. And geographically, it's fascinating to see places like Southeast Asia, Eastern Europe, and Central America really benefiting from this manufacturing rebalancing driven by ICT. It shows where new growth hubs are being built, literally from the ground up.
Okay, and the third type is international project finance, IPF. These are the really big ones, right? Infrastructure projects.
That's right. Think large-scale projects, power plants, major roads, ports. They usually have a significant debt component. Unfortunately, global FDI in these infrastructure sectors stayed weak in 2024. IPF deals actually dropped by about a fifth. And again, it comes back to those tight financing conditions we discussed earlier. Money is just more expensive and harder to get for these huge long-term projects.
And that hits developing countries harder.
Disproportionately so, yes. They rely heavily on these kinds of large-scale infrastructure investments. And since IPF is so crucial for achieving the Sustainable Development Goals, or SDGs, seeing it weaken is definitely a concern for development progress.
Okay, so we have these different investment types, these global shifts. Which brings up a big question. How are individual countries actually responding? Are they changing their policies to adapt?
They absolutely are. National investment policy measures hit the second highest level ever recorded in 2024. We're talking 174 distinct measures adopted by countries around the world.
Wow. 174. And what's the trend? Are they rolling out the red carpet or putting up walls?
Overwhelmingly rolling out the red carpet. A huge majority, 78% of those measures, were favorable to investors.
Okay, so what kind of welcome are they offering? What do these favorable measures look like?
Well, incentives were the most popular tool by far. They made up 2/3 of the measures in developed countries and around 2/5 in Asia and Latin America. And financial incentives specifically really surged. They rose to account for 43% of measures globally and a massive 69% in developed countries. We're talking big money. European countries, for instance, introduced over 33 billion euros in new state aid schemes just for things like industrial decarbonization, renewable energy, and clean tech.
Serious government support. What else besides direct cash?
We also saw a real growth in facilitation measures, making it easier to invest, especially notable in Africa, where they accounted for 36% of measures. Think things like establishing one-stop shops for investors or using digital platforms to streamline processes. Countries like Cambodia, Kazakhstan, Egypt are examples. And then there's straightforward liberalization, lifting restrictions on foreign exchange, like in Argentina and Ukraine, or opening up previously closed sectors to foreign investments. China did this in telecoms, India in the space sector, Ecuador and South Africa in electricity generation.
So lots of efforts to attract investment, but I'm guessing it's not all just open doors. What's happening on the flip side? Any new restrictions?
Yes, definitely a flip side. While many doors are opening, others are being, let's say, fitted with more sophisticated locks. We see these less favorable measures or restrictions popping up too. A key trend is the continued expansion of foreign direct investment screening mechanisms, especially in developed countries. This is mostly driven by national security concerns, but national security is being defined more broadly now.
How so? What falls under that umbrella now?
Well, it increasingly includes things like economic resilience and technological sovereignty. It's significant countries that now have these FDI screening systems account for 71% of all global FDI flows. And you see the line blurring between traditional security and economic sectors. South Korea added national high-tech strategic technologies to its screening list. Japan broadened its scope to specifically include semiconductors. Canada and France added critical minerals.
So it's not just about military tech anymore.
Not at all. It's about economic independence, controlling strategic supply chains. And these screenings have teeth. In Canada, Germany, and the UK, the withdrawal rate for projects facing screening concerns is over 20%.
Wow, 1 in 5 getting pulled.
Yeah. And beyond screening, you see other types of entry restrictions aimed at strengthening state oversight. Angola, for example, banned foreign investment in mining within its natural reserves. Mexico expropriated a hydrogen plant, citing energy security reasons. So it's this complex dance: attract capital, but protect national interests.
And moving from national rules to international ones. Here's where it gets really interesting for me. How are the big international investment agreements, the IAAs, changing to reflect all this?
We're seeing some significant evolution there, too. Over 80% of the IAAs that have been concluded just since 2020 now include specific provisions on cooperation. They're setting up institutional mechanisms, encouraging joint activities between countries. It suggests a more collaborative, less purely adversarial approach is emerging.
Cooperation instead of just protection.
Exactly. And related to that, the traditional investment protection standards themselves are being refined. There's a clearer effort to safeguard the state's right to regulate, particularly around those really contentious concepts like fair and equitable treatment, or ET, and indirect expropriation.
The idea that a government regulation shouldn't automatically be treated as taking away an investor's property.
Precisely. Countries are trying to ensure they can still implement legitimate public policy, environmental rules, health regulations, whatever, without automatically triggering a massive lawsuit from an investor just because it might impact their profits. It's about rebalancing.
That makes a lot of sense. Are we seeing sustainability creep into these agreements too?
Absolutely. It's a major trend. Recent national investment laws are increasingly incorporating sustainability objectives. It jumped from just 5% of laws before 1995 to 40% of laws passed since 2015. And these newer laws also put more emphasis on balancing investor rights with investor obligations. Things like environmental standards, labor rights, corporate social responsibility. 57% of recent laws include these, compared to only 14% before 1995. It's a pretty dramatic shift towards expecting more responsible investment behavior.
Okay, and what about the enforcement side? Investor-state dispute settlement, ISDS, the mechanism where investors can sue states under these treaties, what's happening there?
Well, investors initiated 58 known ISDS cases in 2024. That number is actually down from the peak we saw back in 2018, although these numbers often get adjusted later as more cases become public.
Still sounds like a lot of cases. We're talking big money?
Oh, yeah. The amounts claimed can be huge. They ranged from $17 million up to a truly staggering $45 billion in one case against Australia. There were at least 7 cases in 2024 where the claim exceeded $1 billion. And interestingly, disputes related to mining, oil, gas, energy supply, the extractive sector basically accounted for more than half of all the new cases filed in 2024.
So the old economy's still generating friction. Who's winning these cases generally?
Looking at the cases that have concluded, it's somewhat balanced. 38% were decided in favor of the state, and 29% were decided in favor of the investor. The rest were settled or decided on other grounds, so neither side is having it all their own way.
Okay, let's shift gears now and talk specifically about sustainable finance. This is an area getting so much attention, and the report shows some really big numbers here.
Absolutely. Global issuance of sustainable bonds that includes green bonds, social bonds, sustainability bonds, and sustainability-linked bonds hit a record high in 2024. Over $1 trillion issued in just 1 year.
$1 trillion.
Yep. That's an 11% increase from 2023. And if you look cumulatively since 2019, we're talking $5 trillion in sustainable bond issuance. It's a massive market now.
Where's all that bond money going? What sectors?
The breakdown is interesting. Energy gets the biggest slice, about 35%. Then transport at 19%, buildings at 18%, water and waste management at 10%, and then land use and climate adaptation projects make up another 11%. Gives you a pretty clear map of where sustainable investment is focused. Also noteworthy, social bond issuance recovered for the first time since 2020, and Africa actually accounted for 65% of that total issuance, a significant concentration. And sustainability bonds, the ones with broader goals, continued their strong upward trend, rising 31%.
Okay, so the bond market is booming, lots of green and social labels flying around, but does this translate into money actually staying in dedicated sustainable funds? Are investors buying and holding these assets?
Ah, that's a really important question. And the picture there is a bit more mixed. While the bond market is hot, sustainable funds actually lost some momentum in terms of attracting new money, net inflows.
Oh.
Yeah, net inflows were down about 45% compared to the previous year. Now, the overall market value of these funds did rebound to $1.4 billion, so they're still significant, but the flow of new money slowed. And there's a real challenge, especially in developing countries. If you exclude China, sustainable funds and equities in developing nations actually saw net outflows of $11 billion in 2024. Money leaving, not coming in.
Why is that happening?
A couple of key reasons. One is the lack of robust, comparable sustainability data in many of these markets. It's hard for investors to assess the real impact. The other is just the perception of higher market risk generally. Investors need more transparency and confidence.
That makes perfect sense. If you can't reliably measure the S and the G in ESG, it's tough to invest. How are regulators trying to address this and maybe tackle concerns about greenwashing?
They're definitely stepping up. Regulators are getting more active. For example, the European Securities and Markets Authority, ESMA, brought in new guidelines for fund names in December 2024. They come into effect in May 2025. These rules basically mandate stricter criteria if you want to call your fund sustainable, or ESG. They require mandatory exclusions of certain controversial activities and set specific minimum thresholds for how much of the fund must be in actual sustainable investments. It's a clear push for more market integrity, trying to make sure the labels actually mean something.
Integrity is a huge word in this space, and it seems particularly relevant when we talk about voluntary carbon markets, VCMs. What's the status there?
Yeah, VCMs are facing some real challenges. In 2024, about 287 million tons of carbon dioxide equivalent credits were issued. That's actually down 7% from 2023.
Fewer credits being issued.
Fewer new credits, yes. Now, the market value did rebound significantly last year, reaching $1.4 billion, but still quite a bit lower than the peak value we saw in 2021, which was $2.1 billion.
So less supply, but higher prices push the value up. Why the drop in issued credits, and what's going on with integrity?
It's complex, but a major factor undermining confidence is the integrity issue. The report highlights that around 984 million tons of carbon credits, that's nearly 40% of all credits issued since 2002, have remained unretired.
Unretired, meaning they haven't actually been used to offset emissions.
Exactly. They're just sitting there.
Yeah.
And if credits aren't retired, they haven't achieved their purpose. This raises serious questions about the quality and additionality of many credits, leading to investor distrust. Companies are becoming wary of buying offsets that might not be credible. This withdrawal from purchasing contributes to depressing prices for many types of credits, even as overall market value might rise due to demand for specific high-quality ones.
That sounds like a market needing a serious overhaul. But despite these issues, the big institutional investors, the pension funds, the sovereign wealth funds, they're still committed to sustainability, right?
Oh, absolutely. They are crucial players. Public pension funds manage around $25 trillion in assets globally. Sovereign wealth funds manage another $13 trillion. These giants continue to prioritize sustainability integration. If you look at UNCTAD's list of the top 100 asset owners, 90% of those that report their data have set specific investment targets in renewable energy. That's huge.
And what about net zero commitments?
About 3/4 of those reporting funds have committed to achieving net zero emissions in their portfolios by 2050. We're talking about massive funds like Norway's Sovereign Wealth Fund, NBIM, or Singapore's Temasek. They're setting the direction. And you see national strategies aligning too. Saudi Arabia's Public Investment Fund is heavily financing solar, wind, and green hydrogen projects. Kazakhstan's Sovereign Wealth Fund is developing 6 gigawatts of wind and solar capacity. This isn't just talk. It's real capital allocation happening at a massive scale.
So summing up the sustainable finance picture, lots of momentum in bonds and from big institutions, but challenges remain in funds, especially in developing countries, and serious integrity questions dog the carbon markets. What does this mean for policy overall?
It means the policy momentum is still strong. Sustainable finance standard setting and policymaking continued actively in 2024. Developed economies, particularly the EU, kept strengthening their regulatory frameworks. And developing economies are also making progress, advancing their own sustainable finance taxonomies, looking at carbon pricing mechanisms, and building climate finance frameworks. It feels like a global effort to get the rules and infrastructure in place.
And big international moments coming up.
Definitely. The fourth International Conference on Financing for Development, F54, is happening in July 2025. And then COP30, the big climate conference, is in Brazil in November 2025. Both of these will really emphasize the need to scale up sustainable finance massively. The call is for systemic financial transformation. And a key theme is how to better leverage multilateral development banks, like the World Bank, to mobilize more private sector investment for sustainable goals. The message is clear. The transition needs everyone, governments, institutions, private capital pulling together.
Okay, let's unpack this final crucial area, international investment in the digital economy. Now, we all know this is the fastest growing part of the global economy. So much innovation, so much value creation. But the report highlights a major catch, right?
A huge catch. The investment flowing into the digital economy remains incredibly concentrated. Between 2020 and 2024, developing countries did attract over $530 billion in greenfield digital projects, which sounds impressive.
Yeah, $500 billion.
But nearly 80% of that enormous sum went to just 10 countries.
10 countries get 80%. That really starkly illustrates the digital divide, doesn't it?
It absolutely does. And it's not just about who has internet access. It's about who gets access to the economic opportunities the digital world offers, the investment, the jobs, the innovation capacity. Now, the good news is there's recognition of this problem. The Global Digital Compact, adopted in 2024, specifically commits the international community to closing this divide. It talks about expanding inclusive access, ensuring an open digital space, equitable data governance, strengthening AI governance. All the right goals are there.
The goals are there, but what about the actual investment gap, especially for the basic infrastructure, connecting everyone?
The gap is staggering. The estimate is a $1.6 trillion funding gap to achieve universal digital connectivity globally by 2030. That's the total need.
$0.6 trillion.
And annually, the need for just core ICT infrastructure, the cables, the towers, the basic plumbing, is about $62 billion per year. Yet in 2024, only $14.9 billion in greenfield investment for this core infrastructure was actually announced.
So we're investing less than a quarter of what's needed each year.
Roughly, yes, a massive shortfall year after year. And the needs are most acute in low and lower middle income developing countries, especially for connecting rural and remote areas. Look at sub-Saharan Africa, for example. The estimated annual need to bridge the connectivity divide there is over $14 billion. They're capturing only about 5% of that in actual investment.
Just 5%. It's an investment desert for so many people.
It really is. And even where investment is flowing, like in the Americas, it's super concentrated. Mexico gets 53% of the regional total for core ICT infrastructure. The U.S. gets 29%, Colombia 12%. So even within regions getting investment, it's not spreading widely.
Okay, so huge gaps in basic connectivity. But where is the digital investment flowing? What are the current hotspots?
Well, data centers are a massive target right now. They're driving a huge chunk of that ICT sector, greenfield investment we talked about earlier. Cloud computing, AI, big data, it all requires enormous physical data infrastructure.
Makes sense. Everyone needs more storage and processing power. What else?
Fintech is another booming area, especially seeing a surge in developing economies, with Asia really leading that charge. Building secure, efficient digital payment systems is critical for economic participation, and we're also seeing public institutions stepping up investment in digital public infrastructure.
And the hardware side, making the phones, the computers, the network gear.
For digital equipment manufacturing, developed economies still attract the lion's share of greenfield investment, about $369 billion recently, largely because they have established high-tech manufacturing ecosystems. But among developing regions, Asia is the standout growth hub here, too, attracting $191 billion between 2020 and 2024. Think particularly India and parts of Southeast Asia becoming major manufacturing centers for digital goods.
And beyond the core infrastructure and hardware, are we seeing investment in applying digital tech to development challenges?
Yes, definitely. Areas like health tech, ed tech, smart cities solutions, and agri-tech are all leveraging digital tools to tackle specific sustainable development goals. In fact, the report notes over 70% of the SDG targets could potentially be accelerated through digital solutions. And the big multinational tech companies are playing a role here, too. Google.org supports digital literacy programs. Microsoft has its AI for Good initiative, applying machine learning to health and environmental challenges. Chinese tech firms like Tencent and Alibaba are investing in things like rural digital inclusion and e-commerce platforms to connect small producers.
So a lot happening, but very unevenly spread. This raises that important question again. Are national digital strategies keeping up? Are countries effectively planning to attract and leverage this investment?
Well, most countries now have a national digital strategy. By 2024, that was 86% of developed countries and 92% of developing countries. So the planning documents exist. And these strategies are getting more detailed, more aligned with specific objectives. Things like cybersecurity and data privacy are usually featured prominently now.
But are they focused on attracting the investment needed to make the strategy happen?
That's where the disconnect seems to be. Despite these strategies often emphasizing the role of private investment, specific references to attracting foreign direct investment, FDI, haven't really become more common. For example, investment promotion agencies, the IPAs whose job it is to attract FDI, they're only mentioned in about 20% of the digital strategies in developing countries and just 11% in developed countries. That feels like a huge missed opportunity to actively link the strategy to concrete investment promotion efforts.
Like having a plan but not telling anyone how you'll fund it.
Kind of, yeah, and very few strategies specifically target investment in that crucial core ICT infrastructure we talked about, or even in cutting-edge areas like AI, despite mentioning their importance.
Were there any good examples of countries getting this right? Linking strategy to investment.
There are some notable exceptions. Strategies in Latin America and the Caribbean often do put more stress on attracting ICT infrastructure investment. Malaysia has specific FDI targets for sectors like cybersecurity, AI, and data analytics. Pakistan focuses on attracting FDI for e-commerce growth. Qatar has an explicit FDI attraction program just for the digital economy. Singapore actively promotes FDI into its AI research centers. Costa Rica developed a roadmap specifically to attract semiconductor investment, and India has its well-known semiconductor mission. So some countries are being much more targeted and strategic about attracting the digital FDI they need.
Okay, let's talk about the specific rules and regulations that shape this digital investment landscape. Data governance must be huge.
Absolutely critical. And it's complex. Both developed and developing countries have rules about cross-border data flows, but they vary wildly. You have some countries with strict data localization laws like Egypt or Thailand, demanding that data stays physically within the country's borders. At the other end, you have policies pushing for the free flow of data across borders. And interestingly, we're seeing more and more international treaties now include binding rules on data flows, often prohibiting forced data localization. It's a real area of tension and negotiation globally.
And intellectual property, always crucial for tech.
Yep. Digital investors look closely for countries with strong, transparent IP laws that align with international standards, like the WTO's TRIPS agreement. Protecting software, algorithms, digital content is fundamental. Competition policy is also vital in the digital economy, maybe more so than in traditional sectors, given the tendency towards market concentration and network effects. The goal is to prevent monopolies stifling innovation. And again, we're seeing more IIAs, including specific chapters just on competition rules.
And back to investment screening, does that affect digital deals specifically?
Very much so. Digital economy investments are frequently caught in that national security screening net we discussed earlier. Just look at the numbers. Digital projects made up 60% of all screened investments in Japan between 2020 and 2023, and 45% in Germany over a similar period. So it's a major factor for tech investors.
60% in Japan, wow.
Yeah, but alongside the screening, there are efforts at investment facilitation specifically for the digital economy. Things like publishing clear guidance on how screening applies, streamlining approval processes for digital startups, or fast-tracking investments in key sectors like data centers or semiconductors. Countries are also using e-government tools to make processes easier, setting up technoparks to foster innovation hubs, and creating regulatory sandboxes. These sandboxes allow companies to test out new digital products or services, especially in sensitive areas like fintech or AI, in a controlled environment with relaxed regulations. Brazil, Colombia, Kenya, Singapore are using these for AI, for example.
That seems like a smart way to balance oversight with encouraging innovation. And finally, is there a connection being made between digital investment and the green transition? Because data centers, AI, they use a lot of energy.
That connection is definitely being made more strongly now. There's a growing awareness of the potential environmental downsides of rapid digital expansion, the huge energy consumption of data centers, their water usage for cooling, the e-waste generated, the overall carbon footprint. So the push now is to build synergies. Countries are being encouraged to actively assess the environmental risks when they approve FDI in digital projects. And crucially, to start linking investment incentives to sustainable practices. For example, offering better terms if a new data center commits to using 100% renewable energy or employs highly efficient cooling technologies. It's about ensuring the digital transformation supports, rather than undermines, the green transition.
Right, building a digital future that's also sustainable. Okay, we have covered a lot of ground. We've navigated through these really complex, sometimes contradictory shifts in global investment. We've looked at the drivers behind the overall FDI trends, the ways policies are changing at national and international levels, that growing but still challenged world of sustainable finance, and this absolutely critical, yet highly concentrated, investment landscape in the digital economy. And the World Investment Report 2025 really lands on a powerful concluding thought. It says that digital transformation isn't just something that's happening to us. It's not inevitable in its current form. It is fundamentally a choice. We have to choose to make it inclusive so everyone benefits. We have to choose to make it sustainable so it doesn't cost the earth. We have to choose to make sure this next wave of investment doesn't just digitize the inequalities we already have, but actually helps to level the playing field in our increasingly digital world.
And building on that, perhaps the final thought to leave with you, our listeners, is this question. As we see global investment increasingly converging on these twin transitions, digital and green, how can you, whether you happen to be a policymaker, an investor, a business leader, or maybe just an engaged citizen, how can you help ensure that these incredibly powerful forces truly serve the broader goals? The goals of equitable development, of sustainable progress for all, and not just for a select few. Something to really think about.